Hi, this is CH. I'm starting a new series of videos titled My ABCs, or Absolutely Biased Comments, on one mutual fund per video to share how an individual investor like you and I can try to find out more about a mutual fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I am not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. As this is the first video of the series, what better way to start than picking a big fund name from a big fund provider? So here we go. Let's talk about PIMCO Balanced Income and Growth Fund, or pbig as PIMCO calls it. Now, the first thing we need to figure out as an individual investor is where can we obtain information and documents on the fund. Fortunately, PIMCO, as with most other established fund providers with a strong intention to grow retail business in Singapore, has a comprehensive website with plenty of details on their funds for investors to explore. With the web link here, you can access PIMCO's Singapore website easily. FundInfo is a global third-party consolidator and service provider for fund data and documents, and has information on at least 90% of the mutual funds offered in Singapore. So if there is a need, we will be checking the information on FundInfo as well. For both websites, you should be selecting Singapore Individual Investor or Private Investor settings. Other settings should not make too much difference, but if you are curious, feel free to explore the other settings. There is, of course, also the distributor, which is your bank or online platform that you buy funds from. Do note that they can only provide you information on the fund if they have the fund available on their platform. Last but not least, when all else fails, the internet keeps more information than you know. Just search and you shall be given. I have to say, I don't really like pbig as a short form name, but let's stick with it since this is PIMCO's branding. pbig is currently PIMCO's featured fund of the moment, so there is actually a featured page on PIMCO's website dedicated to the fund that has quite a lot of useful information such as fund features, their marketing angle, managerial interviews, and so on. Being a featured fund means pbig gets extra marketing attention and focused promotions through PIMCO's key distributors, so chances are that you might have seen its advertisements at the train stations or heard about it from your friendly banker recently. A featured fund can typically stay featured for a few months up to a year or so, depending on how successful it is and how much resources the fund provider wants to pump in to support it. Before we go through the fund details, let's spend a quick moment to understand who the fund provider, PIMCO, is and what they are good in. PIMCO is a fixed income investment powerhouse. With over 50 years experience and more than 2 trillion assets under management, PIMCO has established itself as a leading fund provider for fixed income solutions in Singapore and many other regions. PIMCO's fixed income funds are generally decent performers, with especially their flagship product PIMCO Income Fund being a key offering in most banks as a long-term core fixed income fund recommendation. PIMCO puts quite a bit of effort into understanding global macroeconomic and geopolitical changes in order to ensure their funds steer toward the right directions. This is helped by their Global Advisory Board, formed by ex-central bankers and ex-key government officials who can help guide the firm in this aspect. Ng Kok Song, ex-CIO of Singapore's GIC and presidential candidate in 2023, used to be in this Global Advisory Board as well. While PIMCO is well known for its fixed income capabilities, equities and asset allocation are currently very small pieces in their business pie. It is understandable that PIMCO wants to try to grow in these areas. However, this is a key point to think about as we look at pbig. So, let's take a look at what pbig is all about. On PIMCO's website, it stated that pbig was renamed from Global Core Allocation Fund on 29th November 2023. Repackaging an old, small or inactive fund to a new fund is quite common. as it is operationally easier to rename a fund and update its strategy accordingly than to terminate an old fund and create a new one. We will have to ignore all the performance data prior to the repackaging date though, as the strategy likely had some differences compared to now. This means pbig technically has only about 1 year worth of actual track record. PIMCO is marketing pbig as an all-weather fund. All-weather is an ambitious term to use, as it basically means the fund can perform decently through different market situations and cycles. Only time will tell if this is true. pbig is defined to have a 60-40 allocation, which is a common ratio for many asset allocation funds, and long-term portfolio balance asset allocation recommendations. This is not some exciting new strategy in the market, so what PIMCO seems to be trying to do is to slowly increase its non-fixed income offerings, and going for multi-asset is a small but relatively safe step to take. Looking closer at the fund's benchmark, it is actually using MSCI All Country World Index for the 60% equities and Bloomberg US Aggregate Bond Index for the 40% bonds. This suggests pbig will likely be high in US exposures, as well as high in US dollar exposures, which is also what PIMCO is more comfortable with in most of their other funds. For the bonds part, the strategy appears to be similar to their flagship PIMCO Income Fund, which is to run a barbell approach to mix US government bonds for the safer side with high-yield credits and securitized assets for the riskier side. Considering this part of the portfolio should be heavily advised by the existing fixed income teams, it should turn out fine. For the equities part, the strategy appears to be using a systematic quantitative approach, which basically means they are running a computer program with complex calculations and analysis to determine how the top-down exposures should be and what are the specific stocks to buy and sell. This part is a big unknown, as there is hardly any information available on the web to elaborate on PIMCO's capabilities in this area and how successful this strategy has been. Moving from strategy to actual portfolio, we take reference from the October 2024 brochure that shows the current portfolio looks to be quite heavy in US equities with 41% of the 60% equities allocation, and securitized assets, which is adding agency MBS and securitized credit, 19% of the 40% fixed income allocation. The high securitized assets exposure is something to note, as the barbell strategy currently seems to be tilted towards the riskier side. The fund has over 1,000 positions, so even looking at top 10 holdings doesn't really mean much. But at least we can see the top 10 are mainly the agency MBS Fannie Mae and a few mega cap US stocks, so nothing too surprising here. Fund AUM is now over 1.2 billion US dollars, so it is a very healthy size and should continue to grow fast while PIMCO continues to feature it. Given this is a multi-asset fund, it is not difficult to manage the fund several times larger than the current size. PIMCO generally has decent commentaries that provide color on the adjustments they are doing to the fund portfolio following market events or changes in market conditions. It did mention that they maintain their conviction in the securitized assets, hence the overweight. Next, we take a look at the people running the show. pbig has 4 co-managers as per stated in the fund documents. Emmanuel and Irene are from the asset allocation team and appear to be leading the fund, as they are also the duo that did the interview videos in PIMCO's featured fund website. Dan is best known for making PIMCO Income Fund successful, but he is now the group CIO, so his involvement is likely more on oversight and pulling the strings together for the bond allocation in the fund. Joshua is from the asset-backed securities team, and his involvement should be to cover the securitized assets exposures that this fund appears to be placing quite a sizable allocation in. Now, as PIMCO is a fixed income powerhouse, Dan and Joshua have their own successful funds for their track records, but it is difficult to find out how good Emmanuel and Irene are in terms of managing funds. In the PIMCO GIS fund family that pbig is under, I can only find the PIMCO Inflation Multi-Asset Fund that Emmanuel is a co-manager, and the PIMCO Dynamic Multi-Asset Fund, and PIMCO Strategic Income Fund, where both are co-managers. Unfortunately, performance for these funds look quite lackluster. I paid a visit to PIMCO's US website and found that pbig's previous life, that is PIMCO Global Core Asset Allocation Fund, still exists there, and Emmanuel and Irene are the fund managers. The fund's track record is long, since 2008, but the performance has throughout the years been underwhelming compared to the benchmark. So no offense to both managers, but I think there needs to be better evidence to prove that they can run a more successful strategy so that pbig can in turn be a success story. Now let's take a look at the share classes available for pbig. The Singapore brochure listed M retail share classes, which would likely be the default for Singapore retail investors to access. PIMCO funds normally use E share class for retail investors, but in this case has opted to promote M share class instead and has given a discounted unified management fee or total expense ratio of 1.6% for the M share classes. Yes, you heard right, 1.6% is discounted, and the normal E share class has a TER of 2.15%, which is on the high side for such funds in the market. The discount is until 28 November 2028, which is 5 years from the day the fund was repackaged. Looking at M retail share class, there are 3 distribution options available. The first is the usual accumulation share class that I will always recommend people to go for if there is no need for income. The movement of the NAV directly reflects the performance, and if we want to grow our investments, we should let the monies stay in the investments. The second is income share class, where the brochure says it distributes monthly based on organic income and dividends. The third is income 2 share class, where the brochure says it distributes monthly based on expected total returns and give long-term NAV stability. The brochure provides the historical distribution yields as well, so let's take a look and see what this really means for income and income 2 share classes. What we can see here is that income share class is currently paying about 4% distribution annualized, while income 2 share class is currently paying about 6.8% distribution annualized. If we assume the share class descriptions are accurate, we can deduce that the fund managers think that pbig can likely deliver a 6.8% total return in the next 1 year, and therefore is paying out 6.8% distribution for its income 2 share class. Additionally, of this 6.8% total returns, 4% is generated organically from bond coupons and equity dividends, while the remaining 2.8% is assumed to be capital growth, hence the 4% distribution for its income share class. Now what this really means is that for income share class, your investment is currently still growing at about 2.8%, while you took out the 4% as distributions. If the market turns sour and the fund generates less than 4% returns or even negative returns, your investment value will be going down after the distributions. Distribution yield should, however, stay relatively stable, so this is suitable for investors who do need an income stream. The story for income 2 share class is quite different though. Your investment value is not expected to go up, as the share class is supposed to distribute all the expected total returns. So in a normal situation, the fund manager estimates correctly, you collect the 6.8% distributions and your investment value stays unchanged. If, however, the market turns sour and the fund manager changes his outlook, the distribution yield can drop sharply, which means this would lead to an inconsistent income stream. The worst situation is when there is a negative market, which means possibly the distribution yield becomes 0 and the investment value drops as well. Therefore, income 2 share class potentially has a more volatile experience for investors. There is one more special UM Retail Income 2 share class that was offered only during 29 April 2024 to 24 June 2024, which presumably was an exclusive arrangement for one or a few distributors only. This special share class waives off upfront fees, but has contingent deferred sales charge or CDSC, if the investor redeems within 3 years. At the end of 3 years, the share class will be compulsorily converted into the normal M Retail Income 2 share class. Sing Dollar hedged versions are available for all 3 M Retail share classes, so this is well catered for Singapore investors. The distribution used for US dollar and Sing Dollar hedged share classes appear to be similar, so it seems that the hedging cost is factored into the NAV instead. Do take note of that. Last but not least, we take a look at pbig's performance so far. As the strategy is newly repackaged with only about a year of track record, it is a bit early to come to conclusions. Nevertheless, the performance so far appears to be quite closely tracking the benchmark, with some outperformance in the first quarter of 2024, but slightly underperformed thereafter. I'm also not sure how much the fund AUM has grown since repackaging, as large inflows of investor monies can distort the fund performance. Doing some quick comparisons using year-to-date numbers, I get 10.99% if I mix 60% of Vanguard FTSE All World UCITS ETF and 40% of PIMCO Income Fund. And I get 8.15% from BlackRock BGF Global Allocation Fund, which is a long-running multi-asset fund. So it does appear that pbig is still quite decent at the moment in terms of performance. Finally, let's summarize our findings and start with the good stuff. pbig is a featured fund from PIMCO, the well-known fixed income powerhouse. This is a big plus as it means PIMCO will allocate plenty of resources to promote the fund and provide additional information and materials to investors. Knowing more about the fund is always good. pbig is a repackaged fund, and with the sales efforts in the past year, the fund already has a decent AUM size, which means it is in no risk to terminate. The portfolio also looks decently diversified in accordance to the fund strategy. As PIMCO wants to grow its equity and multi-asset business, a fund like pbig naturally becomes an extension for existing PIMCO Income Fund investors to look to invest in, who are already familiar with the PIMCO brand and are confident in their products. Let's talk about the bad and the questionable stuff next. The track records of Emmanuel and Irene is definitely an area that PIMCO needs to work on. Maybe they are running some institutional mandates with great numbers, but if I can't see good performance from their other existing funds that they manage, I will have to maintain skeptical with how pbig will turn out. pbig's 60-40 allocation strategy is not new. There are already many existing multi-asset funds available in the market, so it will be challenging to gain market share. As an investor, there is simply no strong pull for me to choose pbig over others at the moment. pbig's track record of about a year now is still too short to make a good assessment. Most of the time, investors and fund selectors will look for funds with track record of 3 years or longer. pbig's offered share classes, in particular the Income 2 share class, can potentially give investors a volatile experience. So investors need to be clear on what they are getting into. Last but not least, I just want to say again, I don't really like pbig as a short form name. Hopefully PIMCO's marketing team can come up with a better name in the future. This concludes my absolutely biased comments on pbig. Would you invest in the fund or give it a miss? Or are you already invested in it? Do drop a comment to let me know what you think. Additionally, if you find this video useful and would like to see more related contents, please click on like, subscribe to the channel, and share this video to your friends. Thank you and have a great day.